Florida's housing story didn't fade in 25-8. It pivoted, and the numbers prove it. Across the state, the year ended on an upswing that few expected when it began. Early on, sales were slipping, and inventories were swelling. But by late 2025, a pair of forces changed the rhythm. Homeowner insurance premium increases slowed, and mortgage rates fell by more than half a percentage point. That combination unlocked momentum. Buyers stepped back in. Sellers met them. Closings followed. Start with the clearest sign of movement: closed deals. Statewide, 25512 existing single-family homes changed hands in 25. That is a 1.9% increase? No, look closer. It's a 0.9% rise over the prior year. Small but directionally important in a market that had cooled. Under the surface, the pipeline strengthened too. New pending sales of single-family homes ended the year up 1.9% compared to the prior year. December marked the fifth straight month where new pending single-family contracts grew year over year, with 5.4% more homes going under contract than in the same month 12 months earlier. 5 months in a row tells you the turn wasn't a blip. It built. Condos and townhouses told a different story, but even there, the ending had a lift. For the year, 8,793 condo-townhouse units sold statewide, down 5.9% compared to 2024. New pending sales in that segment were down 4.6% at year's end. Yet the last chapter was brighter. Closed condo townhome sales posted 4 consecutive months of positive year-over-year growth, culminating in December with a 10.4% gain versus the prior December. The segment lagged most of the year, but it didn't finish flat. Prices refused to become the headline. They steadied. The statewide median for existing single-family homes at the end of 2000-2005 was $413,990. That is a 1.4% decrease from a year earlier, more a leveling than a slide. In December alone, the single-family median held at $415,000, exactly the same as December a year before. It's not deflation. It's a pause after an extraordinary run. For condo-townhouse properties, the statewide median was $310,000 at the end of the year, down 4.7% compared to the prior year. In December, the condo-townhouse median sat at $310,000, a 1.6% year-over-year decline. Supply tells you everything about pressure points and breathing room. By the end of 2025, single-family inventory stood at 4.6 months of supply. In plain terms, that's roughly how long it would take to sell through the current stock at the recent sales pace. In many markets, 4 to 6 months is considered balanced, neither favoring buyers nor sellers. It was a sharp move back toward normal after a stretch of tightness. The condo-townhouse side, by contrast, showed 8.8 months of supply. That higher figure reflected the slower pace earlier in the year and the adjustments underway in buildings facing new safety and reserve requirements introduced starting in 2020. Necessary? Yes, but it changed the math for some buyers and associations in the short run. If you want the freshest temperature reading, look at the fourth quarter. In October, November, and December of 2017-2, existing single-family homes closed statewide. That was a 7.7% increase compared to the same quarter a year earlier. The median single-family price in the quarter was $413,000, a minimal decline of 0.5% compared to the fourth quarter a year prior. Condo and townhouses also rallied in the final stretch. 2233 units closed in the quarter, up 7.9% year-over-year. The condo-townhouse median price in those 3 months was $300,000, down 4.8% compared to the same period the year before. The volume found its footing. The prices found their level. The air pressure changed. Dollar volume tells the story in bigger strokes. In 2025, the annual dollar volume for single-family home sales reached $154.6 billion. That is a 2% increase in nominal terms compared to the prior year. After accounting for inflation, which was above 2% in 25, the real dollar volume edged down by less than 1%. In practice, that means the market's size, measured in dollars, matched a good number of earlier years. The condo and townhouse market was smaller in 2025, Its annual dollar volume declined 8.5% to $40.6 billion. When factoring inflation, that segment's real dollar volume fell by 10.5%. The split was clear. Single-family went steady to slightly higher in dollar terms. Condos carried more of the adjustment. What changed the current? It wasn't just one lever. It was two. Homeowner insurance premium increases finally slowed, taking some heat off monthly budgets. That didn't erase the issue, but it eased it. At the same time, mortgage rates stepped down by more than half a percentage point by late 2027. That reduction brought more buyers into the strike zone for underwriting and comfort. When those two trends hit together, less upward pressure on premiums and lower rates at the margin, sales responded. You can see it in the 5-month streak of new pending single-family contracts culminating in December. You can feel it in the Q4 gains of 7.7% for single-family closings and 7.9% for condo-townhouse closings. The cause and effect was not theoretical, it was visible and measurable and statewide. If you prefer to follow what people actually sign, look at closings themselves. In 2025, a Sarasota-based settlement firm oversaw nearly $500 million in real estate transactions across Florida. More than $470 million of those were insured transactions, the final mile of the deal, spanning single-family homes, condominiums, and complex multi-party closings. This is not the whole market, and it isn't trying to be. It is a snapshot of throughput, a picture of buyers and sellers that didn't just browse, they executed. Title and settlement desks are where intent turns into ownership. When they are busy, you know something real is moving. There's another thread to pull: regulation and resilience. The condo and townhouse market felt the weight of safety and reserve requirements that began in 2022. These were aimed at building safety and long-term upkeep. The immediate result was added costs and stricter budgets, which pressed sales. That is part of why the condo-townhome segment finished the year down 5.9% in closed sales, even with a late push. But the final 4 months of positive growth, and a December where closed sales were up 10.4% year-over-year, suggested adaptation. Markets adjust. Associations plan. Buyers recalibrate. History matters here because Florida real estate has lived through cycles as dramatic as a Miami thunderstorm. A century ago, in February of 1926, Kenneth Keyes opened a brokerage during Florida's early land boom. By 1933, the company moved its headquarters to the Biscayne Building in downtown Miami. In 1934, they surpassed $1 million in annual sales during the depths of the Depression. 2 years later, in 1936, they were recognized as the largest firm of their kind in Florida and one of the largest in the South. During World War II, they served as the local real estate office for the federal government, scouting military housing locations in Miami and beyond. Leadership grew up through the industry. By 1957, one of their own served as chairman of the National Association of Realtors. In 1968, the firm posted its best year to that point, with $90 million in sales volume. In 1969, Ted J. Pappas acquired the company, and by 1970, he served as president of the Miami Association of Realtors. As technology arrived, the firm turned forward, becoming one of Florida's first brokerages to offer virtual realty services in 1996. The early 2000s, they added title, property management, insurance, and mortgage to their family of services. In 2016, they acquired Palm Beach-based Illustrated Properties and scaled as one of the largest independent brokerages in the nation. In 2023, Christina Pappas became president, marking a third generation of leadership. And now, in 2026, the company marks 100 years. A century of pivots underlines a simple point: Florida real estate doesn't stand still. It adapts. You can see that adaptability in the geographies that keep showing up in the numbers. Watch Sarasota. A title team there shepherded hundreds of millions of dollars, nearly $500 million, through closings in 2025, touching buyers and sellers across multiple regions. Watch Miami. On Lincoln Road in 1930, a second office opened during an earlier expansion. Today, the city's neighborhoods, from Miami Beach to Kendall, still anchor a statewide market that runs on confidence and capacity. Watch Palm Beach. The acquisition in 2016 placed an exclamation point on the state's East Coast arc, tightening connections that matter when inventory shifts from scarcity to balance. The shift back toward balance is visible in inventory. Single-family homes ended the year with 4.6 months of supply. That number matters because it moves power in negotiations. At 2 months, sellers write the rules. At 8, buyers do. 4 to 6 months is the range that many consider a truce, and 4.6 sits inside it. Condos and townhouses close the year at 8.8 months. That bolsters buyer leverage in that segment, and it helps explain the small step down in median price to $310,000 in December, down 1.6% year-over-year, and the 4.8% year-over-year decline in the median price during the fourth quarter to $300,000. Still, the closing counts in Q4 20 to 23 spoke to appetite returning even as supply remained elevated. The single-family side felt almost serene by comparison. 60,872 closings in Q4, up 7.7% year-over-year. A quarterly median of $413,000, just 0.5% lower than the year before. A December median of $415,000, unchanged from the prior December. And the full-year median at $413,900, down a modest 1.4%. At the same time, the full-year dollar volume climbed to $154.6 billion, up 2% nominally. Adjust for inflation, running above 2% in 2025, and it translates to a real dip of less than 1%, still in line with many earlier years. Stability came back into view. Stability isn't the same as stagnation. Numbers moved. In the condo-townhouse market, the year's sales count of 88,793 was lower by 5.9%. The annual dollar volume of $40.6 billion was down 8.5%. But the final stretch, with 4 consecutive months of year-over-year growth culminating in a 10.4% December gain, signaled a floor forming. In single-family, the sustained 5-month run of increasing new pending sales ending in December with a 5.4% pop setup 2026 with a healthier pipeline, those 5 months were the longest such streak since the fevered days of 21, and that context matters as the state enters a new legislative session. Policy will shape the path from here. In Tallahassee, members from across the state gather for Great American Realtors Days, running January 20th through 22nd. Their message to lawmakers ties directly to the forces that move the market in late 2025. Expand housing options, keep property insurance markets steady, continue funding for successful home buying and home hardening programs, and protect homeowner rights. The session is scheduled to end on March 13th. That date isn't just a calendar note. It's a marker by which buyers, sellers, lenders, and associations can measure which levers the state chooses to pull. Throughout the session, the focus remains on proposals tied to housing, property taxes, insurance, homeowner protections, community standards, and professional regulation. The architecture of mortgage rates doesn't sit in Tallahassee, but insurance stability and program funding often do. When premiums rise more slowly, and when hardening funds reach more properties, households make different choices, and those choices show up in contracts and closings. On the ground, that looks like this. A buyer in Sarasota sees 4.6 months of single-family supply and feels less pressure to overreach on price. A seller in Kendall sees Q4 single-family closings up 7.7% year-over-year and reads demand is steady if the home is priced near the median, $413,000 for the quarter, $415,000 in December. A condo association in Miami Beach grapples with reserve requirements that began in 2270 and plots a budget that protects the building while keeping units marketable. A lender in Palm Beach tracks the 5-month streak of increased new pending single-family deals ending in December and underwrites staffing for a spring push. A closing attorney in Sarasota tallies more than $470 million in insured transactions for the year and hires to meet the load. None of that is abstract. It's concrete, and it comes with dollar signs and contracts attached. Step back and consider the causal chain. What happened? Why? Who felt it? And what comes next? What happened is clear in the data. Florida closed the year with single-family home sales up 0.9%, with pending single-family contracts up 1.9%, and with both single-family and condo-townhouse closings rising 7.7% and 7.9% year-over-year in the fourth quarter. Prices didn't fall off a cliff. The year-end single-family median of $413,990 was just 1.4% lower. Condo-townhouse medians at $310,000 at year-end and at $310,000 for the quarter declined, but not by double digits. Dollar volume in single-family rose 2% to $154.6 billion, while condo-townhouse dollar volume pulled back to $40.6 billion. Why it happened centers on two levers and one set of rules. Homeowner insurance premium increases slowed. Mortgage rates fell by more than half a percentage point by late 2025. And condo safety and reserve requirements, introduced starting in 2002, added cost and complexity, depressing that segment's sales for much of the year before late traction arrived. Who felt it? Buyers did, with more options and less pressure in single-family, 4.6 months of supply by year-end, and with more leverage in condos amid 8.8 months of inventory. Sellers felt it too, moving from a sprint to a measured pace. Lenders, agents, and title companies felt it as throughput rose in Q4. The Sarasota title team's nearly $500 million in closings and more than $470 million in insured transactions tells you the operational machinery ramped back up where it counts. Now, what's next? Base case Florida enters 22-6D with a market that looks stronger and more sustainable than a year ago. The late 2025 trend line, 5 straight months of rising new pending single-family sales culminating in a 5.4% December jump, and fourth quarter gains of 7.7% and 7.9% in single-family and condo-townhouse closings, sets a stable rhythm. Inventory in single-family at 4.6 months and condo-townhouse at 8 months suggests negotiations won't be one-sided. Prices look poised to move with fundamentals rather than whipsaw. The architecture for that base case is already visible in the data that closed the year. Two watch items could tilt that path in the next 90 days. First, insurance and policy outcomes in Tallahassee. Great American Realtors Days runs through January 22nd, and the session wraps on March 13th. Measures that keep property insurance markets steady and extend funding for home buying and home hardening programs would reinforce the late 2025 momentum. If those initiatives stall or reverse, the burden may shift back onto monthly budgets, particularly for condos managing post-22 to reserves. Second, the flow of new contracts. December's 5.4% year-over-year increase in new pending single-family deals capped 5 consecutive months of gains. If that streak extends through February and March, the closing counts for the second quarter will likely reflect it. If it breaks, expect Q2 pacing to ease back toward flat against last year's tougher months. Florida is no stranger to cycles. A brokerage founded in February 1926 moved headquarters in 1933, crossed $1 million in annual sales by 1934, and posted $90 million in sales volume by 1968. It survived war, recessions, and disruptions. It acquired a Palm Beach firm in 2016 and handed leadership to a new generation in 2023. Today, as the state steps into 2026, the same principles apply. Adapt to the forces that matter. Watch the numbers that tell the truth. Keep an eye on supply, 4.6 months here, 8.8 months there. Track the medians, $413,990 for single family at year-end, $310,000 for condos. Follow the quarterly pulse, 6,872 single-family closings in the fourth quarter, 21,1233 condos and townhouses, and count the dollars as they really move, $154.6 billion in single-family volume, $40.6 billion in condo-townhouse, each pointing to where demand chose to live last year. The story of 2025 wasn't a wave crashing. It was a tide turning. Sales in single-family rose by 0.9% across 255,012 closings. Pending single-family contracts ended up 1.9% for the year, with December up 5.4%. Condo-townhouse closings, down 5.9% for the year, ended with 4 months of growth at a December up 10.4%. Single-family inventory reached 4.6 months. Condo-townhouse supply sat at 8.8 months. The fourth quarter delivered 7.7% and 7.9% gains in closings across the two segments. The statewide single-family median price in December held at $415,000. Those are the signals that matter. They are concrete, they are local, and they are recent. There's one more piece to remember. Sentiment is built transaction by transaction. Every insured closing, more than $470 million worth for one Sarasota title team last year, reinforces that buyers and sellers are still making long-term decisions in this state. Not just thinking, acting. When you add in a policy calendar that runs from January 20th to March 13th, and an industry presence of thousands of professionals stretched from Miami Beach's Lincoln Road to Palm Beach and back across Sarasota, you get a market that is watching closely and moving deliberately. Base case, Florida holds its line of late 2025 stable single-family prices, balanced supply at 4.6 months, and steady contracts that flow into spring closings. Upside risk sits in policy wins that keep insurance markets steady and keep hardening funds flowing, reinforcing buyer confidence. Downside risk sits in a stall in the condo-townhouse adjustment or a reversal in the 5-month streak of rising new pending single-family deals. The range is visible. The stakes are real. The dates are set. If you want clear-eyed, number-driven reads on Florida's housing heartbeat as 2026 unfolds, stick around.